Hello and welcome into the KE Report. I'm your host, Shad Markwitz, and today we're getting an update from our friend and colleague, Nick Hodge. Nick is the co-owner of Digest Publishing and editor of Foundational Profits and Hodge Family Office. And we'll put a link below so you can follow along with all the publications over at Digest Publishing. Nick and Gerardo have a good team, and they put out a lot of different information that gets into both the macroeconomic trends that we see in the marketplace and also the micro trends we see in the resource sector. And they even cover cryptos and various markets at Digest Publishing. Nick, just from that standpoint, digging into the macro first, we just had Jerome Powell wrap us up at Jackson Hole last week on Friday, indicating kind of a dovish stance going into the September FOMC meeting. Expectations from the market are that we are going to get the first cut that we've had in, I think, 9 months. So starting back up the cutting cycle and easing cycle. Markets responded favorably across the board. We saw general equities up, we saw commodities up, we saw cryptos up. So all around good news, unless you're the US dollar. A lot of consternation still within the Fed, though, about the tug of war between possible inflation from tariffs, but also looking at the jobs market. Anything you want to weigh in on as far as the macro trends we're seeing out there?
Well, last month, you and I, Shad, were singing Everything Was Awesome from the Lego movie, and not much has changed since then. My outlook for the year has been that we weren't going to get a recession, that inflation would be sticky high, but that growth, U.S. economic growth, would be enough to provide cover for that inflation to allow markets and other investment vehicles to appreciate in price. And that's exactly what we've seen. Last month, we were talking about the passage of the big, beautiful bill that was going to stoke inflation and add more debt to the US's already egregious tab. And that started to play out. And then we got a job scare, if you remember, that caused just a little bit of volatility in July and early August. And I had been telling my subscribers that we would use any downside volatility in these months, July and August, to position for what I thought was going to be very robust into the year, fourth quarter, October, November, December. And that's sort of what we got. So, growth is very strong. The second quarter print came out at 3%. And so nowhere near a recession. And at the same time, inflation is right around 3%, 2.6, 2.7, but likely ticking up a bit higher. And to your point about Jackson Hole and the unelected officials that dictate your monetary policy without any input from you, they're going to go right ahead and cut those rates in September, despite inflation being nowhere near their 2% target. So the mantra for me is more of the same. The Fed is not your friend. They're diluting your purchasing power. Look at the chart of the rates and the dollar. They continue to be down and to the right. The DXY below 100 at 98. And that bodes well for a lot of assets. As I said last month, the dollar goes down. The things that you buy in dollars have to cost more of those dollars, i.e. the price is higher. And that's certainly true for a lot of metals, precious metals, and other commodities, whether we're talking about rare earths or lithium or gold or silver or PGMs or even the entire S&P, which is back at all-time record highs as you and I speak, Shad. So a lot to like out there and a lot more to discuss. So happy to go anywhere you want.
Yeah, I think you raised a great point about them being unelected officials, but they're still dictating the monetary policy for our currency that we spend as citizens every day. And so as the dollar drifts lower, everything else costs more, and that's just inflationary by nature. Maybe just one follow up. We have all these people expecting a series of rate cuts. They're expecting 100 to 150 basis points. But if inflation does rear its head, it seems like it's going to be very difficult to keep doing this series of cuts. So I don't know what one cut of 25 basis points, or even if it goes up to 50, I don't know what that really does in the overall scheme of things. But if there was a series of cuts, that would be germane. But if there's higher inflation, how can they do both at the same time?
Yeah, I don't know. The Fed is infamous for backing itself into a quarter, and everybody gets myopic on looking what they're doing. To separate the signal from the noise is what I think you have to do, and the signal is this: look, the dollar's already weak, inflation is already high, and gold is already near record high prices at $3,400 an ounce. Their very willingness to advertise these rate cuts, the speech that Jerome Powell gave last week, after which the Dow went up like 900 or 1,000 points, is basically kowtowing to asset owners and those in the government, e.g., the president, who wants rates to be lower for obvious reasons, right? Like financing and refinancing and servicing the debt and all that is great for asset owners. So, me and Gerardo talk about this all the time on our podcasts. Like it's a bifurcation of America. We've heard about the K-shaped recovery. We've heard about, wealth inequality for years. And you need to really get the message here is that they're going to erode the dollar and they're going to erode your purchasing power, and you need to own assets to combat that. Whether that's again the S&P, which is at record highs, or some version of crypto. I know Bitcoin is soft the past week, but did just run to record highs above 123,000. Ethereum is sort of taking the lead there. We bought that a couple of months ago in my monthly letter and have doubled our money on ETHA. So on down the line to other commodities, right? You need to own these things that are going to preserve your purchasing power and go up in price as the government and the Fed continue to do things that erode the power of the dollars in your pocket. And so, how do they do it is I don't know. And frankly, I don't worry about it all that much. I know what the ramifications of them doing it are going to be, and you can sort of see that play out in the market, not just in the commodity prices, but in the related equities as well, which I obviously know you follow, and you can just see them breaking out, whether it's GDX, GDXJ, URA, LIT, on down the line for these various commodities, and you can see the chart is going up and to the right in a big way, and then into the on down the value chain to the smaller companies where I spend a lot more of my time is some of those are just melting higher as they put out drill results and as this message trickles into the broader market. I was just talking to somebody from a pretty big newsletter marketing firm that, has tens of thousands of paying readers. And they were saying that they were having like a macro call for subscribers the other day, and they were seeing more commodity questions than they've seen in a long time. So I was mentioning this last month when we talked, but for years, literally years, we've been scratching our heads, asking ourselves the question, right? Like, when is retail going to come? When are the younger investors going to come? And it seemingly happened in real time. You can see a true reflection of a sea change in the public psyche, in the valuation of these stocks and the response they're getting to news they put out. And I expect more of that to continue as you do get these rate cuts. I don't know how many rate cuts we get. It looks like there's a 50% chance we go to, between 3 and 3/4 and 4% at December by December. So that's a coin toss. But again, it's the very willingness of Powell to get up there last week and say 2% inflation is basically you're not going to see that, right?
Well, I think you raise a great point that it's really a reflationary trade in many asset classes. As the dollar drops and as the purchasing power drops, everything has to go up. But you're seeing executive orders from this administration focused on mineral resource scarcity and development of domestic resources. And it's also, we've seen executive orders that involve critical minerals, and we've seen bills that are passed on a fiscal side that also include money to help develop nuclear and to help talk about we need to have some of these Chinese export bans resolved with rare earths. And we've seen, the government get involved with tungsten and rare earth projects and lithium projects, and Canada's doing it and Europe is doing it. So it's not just a United States thing. It's also a global thing, a focus on where does all the stuff that we create in life come from? If it's not grown, it's mined. So with that backdrop and with the idea that you're hedging this process and not staying up at night about it because you know how it's going to play out, we should just maybe briefly touch on gold. You already mentioned GDX and GDXJ shooting up and to the right. We have seen gold kind of hold steady, but channel sideways at record high levels historically. Silver getting on the bid and popping up, and even platinum and palladium getting a little life, which we hadn't seen in a while. So when you look at the precious metals complex, any thoughts that you have as far as how you think this may play out in the balance of this year?
I mean, it's a bullish consolidation continuation pattern. You mentioned the range for gold. It's pretty much between 32.75 and 34.30, and it's consolidating there for the next leg higher. This isn't a bearish chart pattern by any means, and the fundamentals continue to flash bullish indicators. We just talked about the dollar and rates and Fed cuts. We haven't mentioned the continued buying of Eastern central banks. China continues to buy gold, et cetera. And so the debt's not going away. And I think we're gearing up for the next leg higher in the precious metals complex. So it's a pretty easy take there as far as I'm concerned. And what I'm concerning myself with more is the equities now, how to play that. We've talked over the summer about, drill campaigns that were going on. We're getting very close now to having assays or visual results from a lot of companies. And so I don't think that precious metals trade is going away anytime soon, and continue to build positions there in quality explorers that have catalysts ahead. So, in the future, I think silver has its own moment. I can't tell you exactly when that comes, but we all know that the gold gets the bull market going, and then silver sort of finishes it off in its erratic nature that it has. And so I have long-term bets in silver that I expect to play out beneficially once that rip-roaring silver bull market comes. But with growth at 3%, inflation at 3%, it's you sort of gotta own precious metals. And I see more people coming into the trade as well, right? Sort of what I was just saying a couple of minutes ago is I just see, hear, feel more people talking about gold, wanting to include gold in their portfolio, using it as a hedge against dollar debasement, and certainly we know gold is still under owned amid the masses, and so there's another catalyst you got there. So gold, silver remain bullish, and there's opportunities there if you'd like to talk about those. I know your subscribers like to hear names. One name I bought last month was Royal Gold. That's a big royalty company, right? One of the top three. But it had a misstep, at least in its chart and stock price, when it acquired Sandstorm and sold off pretty sharply. And I was quite content to buy that dip and put it out to my subscribers. And I think we're up something like 10% in a month or something like that. And so for a while, and I've said this before, sometimes I feel like a broken record. It was buy the dip in the Nasdaq and the S&P for the past decade or so, and now it's time to buy the dip in the gold and precious metals complex. And I've seen that pay off now multiple times in recent months, and will continue to do that until it doesn't work.
Yeah, it's a good point. I think a lot of generalist equity investors are very accustomed to buying the dip. They've been buying the dip really ever since the great financial crisis in '08 and '09, ever since that upward trajectory started, with the rare exception of the pandemic crash or the 2018 taper tantrum or the blip that we saw in 2022, which was not much in the overall scheme of how much the markets have gone up over the last 15 to 20 years. So it's now finally translating over into the commodity sector where people are buying the dip in gold stocks, buying the dip in silver stocks, buying the dip in uranium stocks, and it's paying off. And they're getting shorter and more shallow than people expect and running further to the upside. So now the surprises are finally to the upside. And now when companies put out news, those surprises are to the upside. Instead of being liquidity events, they're actually events where people are kind of piling in, and you are seeing some new investors come into the sector. Well, another metal that we talk about often, and we haven't really unpacked this with you since our last call, is copper. So if we shift from the yellow metal to the red metal, copper has been on kind of a wild trajectory. If you look longer term, it's actually in an upward trajectory the last couple of years, and it's been making higher highs and putting in some higher lows. But we did have some volatility around if there was going to be a tariff on copper, and everything shot even higher on that news. And then when it was clarified that, hey, it's just going to be on finished products like copper wire or piping or cables and fixtures, but not necessarily on copper itself, not on the concentrate and on raw copper, we saw the price collapse. And so I wanted to get your thoughts on how you're navigating that, because some people are now bummed out. Other people see it as a buy to the dip moment in copper. How are you playing the red metal and the related copper equities?
Yeah, you're 100% right. Copper is in an uptrend. I believe it started in 2020, a new commodity super cycle, and there will of course be ebbs and flows within that. But if I put up, two channel lines going back to 2020, the downside is, line is right around $4.05, and copper is still well above that. And to the upside, it's at about $5.50, and copper did get a little bit ahead of that before it had a vast sell-off. So let me take a step back and just say that, if we're entering a commodity bull market and the world needs critical minerals and we're going to have an AI and EV revolution, that copper is sort of the most critical metal there is. In fact, the Department of the Interior in the United States just added it to their list of critical minerals this week, I believe it was. And so let's start there. That's sort of the reason that Trump is interested in it. It's the reason he's got the Commerce Department doing the Section 232 investigation. And it's the reason he spouted off at the mouth about tariffs in early July, which sent copper prices to nearly $6, right? And I was telling you last time that that didn't really make a lot of sense because the U.S. doesn't produce enough copper to like sustain itself and do the things it wants to do. So I didn't know where the copper was going to come from. And in that context, I was buying sort of the biggest domestic name there was, which was FCX, Freeport McMoran, right? And that trade did work out. And then what happened is somebody told Trump that the tariffs weren't a good idea, and he backtracked on them and said, "Oh, we're going to exclude finished products." And the bifurcation that had emerged between the London price and the Chicago price or the COMEX price sort of erased itself. But what that translated to was, one of the widest red candles I've ever seen in a huge commodity in my career. You had sort of in a single week, copper go from 575, 580 down to around 434. And so that changes the narrative, right? The government cuts both ways. The government giveth and the government taketh away. And so once he said that he wasn't going to tariff, it became apparent to me that we could navigate our copper portfolio, at least on the large safe side of the copper portfolio, outside of the United States. And so I took profits on my Freeport position and my big, monthly macro letter where I manage safe capital. And we bought Ivanhoe, right? Buying the dips again, back to that theme. Ivanhoe had a dip because there was some seismic activity around one of its underground mines, needed to be shut down for a little bit, do some dewatering, restabilization, et cetera, which we now know is going well. And lo and behold, the Ivanhoe trade is now working out. So that's just how you navigate an evolving market, right? You didn't know, no one knew that he was going to backtrack on tariffs, that copper was going to go from 6 to 450 in a couple of days. But you sort of deal with it, right? And so the number one rule is not losing money. And so we did what I just sold, what I just said, locked in the profits on FCX and bought the IVN, and that'll be our big sort of copper play for the next couple of months as it brings that mine back online and the market continues to play out. So. And then on the smaller side, I don't think anything changed, right? As far as the developers and the explorers, copper remains in a bull market. It's got a structural deficit that's going to last decades, all that sort of stuff, right? So no change on the small end of the spectrum and the explorers, developers, prospect generators that I've discussed with you in the past.
Yeah, I was going to ask you that if you changed those, but it didn't really make sense to because the thesis is still in place for the longer term trajectory. And if you're exploring for copper, make a discovery, you still will be rewarded. And if you develop a project that a major wants to buy, you also will be rewarded. So most of it sounds like you were dealing with the producers and playing a little bit of the volatility and buying the dip in Ivanhoe. It's an interesting thought there on Ivanhoe Mines, traded on the TSX under the ticker IVN. So
And
let's
just one other thing on copper shed is the stocks on the small end of the spectrum continue to be rewarded, whether, copper's at 6 or 450. Look at names I've owned in the past, like Gladiator, man. I think they just raised 20 or 40 million bucks, like close to a dollar, right? They're drilling up in the Yukon with a nice project. Or gosh, there's other names. Like a couple of weeks ago, I was telling you about Kincora, which we financed in the Macquarie Arc of Australia. Well, a company whose name I can't pronounce, Wahati or something like that. They made a discovery recently that, sort of added 70% or a double to their market cap in a matter of a week or so. And so positive drill results are still being rewarded in the copper exploration and development space for sure, perhaps even more poignantly than they were when copper was closer to $5 than four.
Well, and it also just has, to the point we made at the onset, more generalists are now looking at something like copper, where maybe last year they couldn't even spell copper. Because if you have an administration specifically calling out a mineral or a metal and saying, hey, we're going to put tariffs on it, a lot of people that probably could care less would think, well, why? And if they do any 5 minutes of study, they would start realizing the copper thesis and how important the supply demand fundamentals are, what the US has, what we import. So I think that there's probably more eyeballs on copper now than ever before, despite this volatility, because people are realizing, oh, wow. And we see that reflected in the material sector and the industrial sector doing well in the stock market. So I think there's more people in general following these minerals and metals. And another one we've talked about before is rare earths. People that could care less about mining or could care less about minerals extraction are now talking about these funky, 17 little metals that are hard to pronounce and all across the elemental table at the bottom. And they are something that's very important because of the Chinese export bans and how they're used in technology, they're used in defense, they're used in lasers, they're used in energy, in EVs and applications and computers and technology. So because there's such a focus on rare earths, and when we saw the government come in with MP Materials and do that deal, which I think we discussed last time, where they actually became the biggest stakeholder in MP Materials, I think a lot of people that didn't know how to spell rare earths a couple months ago are now watching that space. So any developments there as far as how you're playing rare earths?
No real developments on how I'm playing them, except for higher prices in the stocks I own that are related to them. A couple of companies I've mentioned to you a bunch of times now. Energy Fuels, which is processing rare earths, including the heavy ones, and has made multiple deals in recent months. And those shares have gone from sort of, I don't know, $3 or $4 in April this spring to hitting a high of over $13 in the past week as the message continues to reverberate through. So I guess the thing I would say concerning rare earths is that, it never went away after the 2010, 2011 run, the underlying fundamental problems with security of supply, and they're still with us today. And it seems like there's actually some follow through from the government this time in terms of solving the problem. So, and not just MP Materials, which we discussed the other time, but the State Department has been having meetings talking about increasing the recycling of rare earths in the United States. And I've been invested in a company called Cotech Holdings for over a year now that is building a rare earth recycling facility in Texas. In fact, they're at the feasibility stage, and they just announced this week that they're starting to stockpile their feedstock for that project, which they expect to be up and running in late 2026 and producing revenue in 2027. And I continue to expect companies like that to get government support, given that they're already at the table with the State Department, and given the continued announcements we see from various agencies of the federal government and the president himself. And the last thing I would say on rare earths is that you had the announcements from China and the trade wars a couple of months ago at this point about the export bans of magnets, et cetera. You had the MP Materials deal, but now what you're seeing is a follow through on the price. So I know rare earths prices are a little bit opaque, but you can find them if you do some digging and you know who to ask. And prices for neodymium are up like 50% in the past 6 months, and so now you're getting this and you follow through the actual price of the commodity as opposed to just announcements of export bans out of China, by the way, some of which have been eased, and you still have the price going up. So that's another sign or signal to me that, this is a real bull market that's going to have legs, and not just a flash in the pan that's going to go away after 3 or 6 months. I think you're setting up for sort of a 12 to 24-month run in rare earths as these announcements continue to cascade from companies and governments that are actually building projects and deploying capital to, bring the production and processing of those rare earths westward, which I would add is sort of my entire investment philosophy and has been for a decade, right? Is the West exported all the production, processing, refinement of these metals to the east and the emissions that went with them. And that was clearly unsustainable for many reasons, security of supply, environmental, geopolitical, military, strategic reasons, all that. For all those reasons, the production of these metals, not just rare earths, but copper, antimony, metals you've never heard of, cesium, gallium, indium, all those things had to migrate west. And that's been sort of my overarching philosophy for about a decade now, right? So it's the reason I have my flag so firmly planted in the firmament of the resource space.
Well, after planting that flag a decade ago, it's finally an overnight success, Nick. Now we have everything from antimony and germanium to tungsten and rare earths all getting the limelight, and rightly so, because we're trying to move that processing capacity and separating capacity here domestically, or at least with friendly nations and friendshoring and nearshoring. And to the point you made about Cotech and MP Materials, Apple came into MP Materials because of the recycling of permanent magnets. These are not magnets for the fridge. These are the kind of magnets used in electric vehicles or in windmills or in, high intensity aircraft and also in defense projects. So they're very important. And Kotex doing the same kind of thing. And even Energy Fuels just announced this week that it's joined forces with Vulcan Elements to make, guess what? Permanent rare earth magnets. So a lot of focus there. But all these other niche metals like the antimonies and germaniums and all these other things getting the limelight, I think just is symptomatic of how important the supply chain has become. And really with the pandemic, I think people started focusing on supply chains for the first time in decades. And so I think all of that bodes well for the commodity sector. Another area that we've talked about before that's had four different executive orders this year is nuclear power and uranium. What was a curse word a couple of years ago is now the savior of the green energy movement. So when you look at uranium stocks, man, they really got hit hard in the DeepSeek news earlier in the year. Then they got hit hard in April after Liberation Day. Then they started clawing their way back higher, and nuclear stocks did well. Utilities that are tied to the power generation did well, and uranium stocks did well. Then they got shellacked last week. One day I was like, holy cow, these things are down big because of Kazakhstan saying, hey, maybe we'll produce more. And then a couple days later, they said, oh, maybe not. Maybe we won't produce as much as we thought. So, with the wild roller coaster in nuclear stocks and uranium, any changes there, or how are you playing that sector, Nick?
I bought the dip pretty good in two ways, and I'll just talk my book. So in the monthly letter that I view as more safe and long term, we own URNJ, the junior uranium ETF from Sprott. And in last month's issue, I said again, expecting a little bit of volatility in July and August, that we were going to add to our position in URNJ if it fell below what I issued as the buy under price of 1975. And this is when URNJ was trading up around 22, $23. And when you say it fell out of bed the other week on that Kazakh announcement, it went precisely to 1946 on the low wick of the candle. And my limit order got filled to add to my URNJ position, i.e. buying the dip. And lo and behold, it screamed in the next 3 days back up over $24 after falling below $20. So again, pointing to that phenomenon of buying the dip in the resource market is now something that works. I'm not going to take you through the fundamentals of nuclear and uranium. Those are pretty well known and it's not going anywhere, but public sentiment continues to shift. Japan continues to come on, and we've obviously seen all the tech announcements. You can't have clean AI or data centers without nuclear and then in turn uranium. So I believe it's in a long-term bull market. And I also, and this is a good point for your readers, I think that 70 becomes sort of a new floor, looking at the chart of the spot price of uranium and sort of where the levels have been previously going back 5 years and what we've seen in the past year. It looks like the uranium price wants to consolidate and put $70 in as a new floor, which would be great, obviously, for some of these prospectors, explorers, and developers. You mentioned the executive orders. We've seen now more than one project selected by the administration for fast track permitting. from Anfield Energy and from most recently Uranium Energy Corp, Miranani's UEC. So a lot to like in the uranium space, and it's a space I've been in for some time. So I often tell you about companies I'm financing and what I'm buying because that's sort of my whole deal. That's what my newsletters are based on. That's what I'm writing about, how I'm managing my own capital. So since the last time you and I spoke, I've participated in one new private placement, which is something I do several times a year. I like participating in private placements. I have a letter dedicated to those. And we went into North Shore Uranium this month. The deal is still open, although it's well oversubscribed and will be closing soon. And this is a company that is relatively new to me, but as you know about me by now, structure and people are hugely important. So has a very clean structure with management owning something like 40% of the shares, all of which were bought at higher prices than the company is currently financing itself. And it brought in an asset with a historical resource of 11 million pounds of uranium in the American Southwest that was actually going to be a mine in the 1970s. Like the shaft was sunk and everything, and then it ended up not producing. Uranium went out of favor, prices fell, and nobody's done anything with this project since the 1970s. Management thinks that it might be ISR amenable, and so that's the reason for the raise. You know, they're raising $2 million to go do some work. This is a tiny little company, sort of 5, 10, $15 million market cap. I could easily justify a market cap, 25, $30 million higher just based on the historical resource they have. But if they can prove that it's amenable, it's going to be worth much more. And so the structure works and the people work as well because one of the largest shareholders and strategic advisors is a gentleman named Blake Steele. And we've tangled with Blake Steele in the past because his former uranium company, Azarga Uranium, acquired one of our small companies a couple of years ago called URZ Energy, which itself was a reiteration from Dennis and Darcy Higgs from their previous success in the last uranium cycle of Uronors. So they got the team back together. We financed URZ Energy. It was taken out by Blake Steele's Azarga, which was in turn taken out by Encore Energy. And I think all said and done, we made over 1,000% on that with our various shares and warrants and the acquisitions that took place with Azarga and Encore. But Blake Steele knows what he's doing in terms of uranium deposits in the US and advancing them. Azarga had a project called Dewey Burdock, which is in South Dakota that had significant permitting issues that he was able to get cleaned up, get the Nuclear Energy Regulatory Commission license back in good standing, which was the reason that Encore Energy ultimately took them out. And so, Blake coming into to North Shore, giving his blessing, saying that he's going to advise it, having real skin in the game, that's enough to convince me, my network, and other folks I run with to write checks into a deal like that. And that's precisely what we did. So I think North Shore Uranium is going to be a pretty exciting uranium story going forward.
Well, man, I really appreciate you highlighting that for our listeners here, Nick. And yeah, I was actually in Azarga Uranium myself, in full disclosure, and then that's how I got over into Encore was during that takeover. So excited to see them put the band back together again and work on the next project, especially if it could be ISR amenable. So definitely keep following that company, and maybe we'll try to get them on the show for listeners here. One other thing we'll just squeeze in really quickly here is as far as buying the dip, talk about a dip, lithium. Lithium had a couple year dip here, a little bit different trajectory than some of the other commodities that we've talked about thus far, but it is seeing some life again. And I have noticed that the lithium ETF and a lot of the lithium stocks are starting to get off the mat and starting to have some upward trajectory. Anything you want to say about lithium stocks?
As a wrestler, I appreciate the analogy. Lithium's up 40% in the past 3 months. It's been left for dead, right? You guys remember when the price of lithium carbonate in sort of 2020 to, I don't know, 2021-ish went from eight or $10,000 a ton of lithium carbonate up to around $80,000. And then it made a round trip in the past couple of years, and all the names came back down. As you say, it's starting to perk back up on the LIT ETF and on the price of the underlying commodity as China And it always comes back to China, doesn't it? As China seemingly gets serious about, curbing excess supply, and as we continue to see pretty robust sales globally of electric vehicles, even Ford recently doubled down on their commitment to EVs, saying they were going to offer a small truck that Americans obviously love their trucks that is all electric, and they're retooling factories to do so. So these global auto manufacturers are still on board. Sales are still robust. But as I said, the price of lithium has crashed, and that's par for the course in the resource cycle, which is cyclical, right? High prices beget low prices, and around and around we go. And so, the lithium space is one we're pretty familiar with as well. I mean, not to make this all about my track record and what I've done, but even in the first sort of what I view as the first lithium run, sort of 2015 to 2017, we were financing and having successful exits in companies. I financed Lithium X at 15 cents, and it was bought out for over $2.50 less than 2 years later by a Chinese entity. And we also financed Advantage Lithium during that time frame, which was ultimately taken out by Orocobre. And so which went on to merge with other lithium entities and is not called Orocobre anymore either. And then in the next run, the one I just laid out for you in 2020, 2021, we also financed a handful of lithium stocks that did quite well, and one has turned into what is now the proven best undeveloped hard rock spodumene deposit in North America, if not the world. And that, of course, is the Corvette or Shakichiwanan deposit controlled by Patriot Battery Metals, which my partner originally financed at 16 cents, and it went all the way up to $17 during that run. That's 100 times your money if you're keeping track here. So, and then that stock, as you just said, round tripped, it was all the way back down to the low twos or the high ones, even from $17. And then just in the past couple of weeks here, that stock is back above $4. They've continued to execute, as I said, the best undeveloped lithium asset in North America. But by the way, they discovered a cesium asset on that same project that's probably more valuable than the lithium. And so the story has gotten even better during the bear market. And I think that's a name that people will flock to, if lithium continues to catch a bid. And then I'll just keep talking my own book. Another financing that's open right now that we put out to our accredited high net worth investors is Lion Rock Resources. So this is a company with an asset on private land in South Dakota, which is a famed historic mining district, Homestake, et cetera. And it's on private ground. So they were able to easily get a permit. And this is probably the highest grade lithium prospect in the United States. The grab samples from the outcropping pegmatite, they're coming back at 4 and 5%, which is 4 to 5 times the typical economic grade of 1%. And by the way, there's also high grade gold there. So it's a unique deposit in that it's a gold lithium tin project. And the gold grab samples have come back as high as 189 grams per ton. I did not misspeak there. And yet, the project has been locked up with the same family for over a century, has only seen, I think, 8 drill holes before World War II. And we're about to drill that thing in the next month here. So another exciting one to look at. If you could get a 5% grade on a lithium hole, I think we might even be at a point where pictures of the white specks might be enough to move stocks in this market. And so just a couple of names for you to take a look at there that we're involved with and are getting involved with.
Well, man, I really appreciate that. That's interesting to have gold, lithium, and tin together. What a mix there. But I appreciate you mentioning all the companies and some of the history from the different cycles in lithium because I think it lends credence to your ability to know when it's time to beef up positions and finance companies and when it's time to ring the register on a winning trade. So that seems to be the theme for this whole interview is buying the dip when it's the right time to buy the dip. And there's no perfect time, but I think there's still a lot of opportunities for investors on the sidelines to follow along with all these markets, whether it's the precious metals or copper or uranium or lithium or rare earths. And when you see pullbacks, if it's a quality company with a quality management team and you missed it, a good time to nibble in on pullbacks because inevitably the reflationary trade is going to lift all these things higher as our dollars and other fiat currencies continue to buy less and less of the goods that move the world. So, Nick, always great having you on the show. Always great to dig into what's on your radar and the stocks when you talk your book, I think are very germane for people listening in. So definitely people check out the link down below and you'll go over to Digest Publishing and you can see all the offerings that Nick and Gerardo offer to readers there and even some of the other team members they have. So appreciate you spending some time with us here at the KE Report. And as always, Nick, looking forward to our next conversation.
It was a pleasure, Shad. Thanks.